Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent, licensed in all 50 states. I want to welcome everybody on the podcast platforms, iTunes and Spotify and all that. Welcome to you, and also welcome to the Fun with Annuities YouTube channel viewers. We're taping this today. And as you know, at Fun with Annuities, our saying here is live in the reality, not the dream. Live in the contractual realities, not the sales pitch dream. And I do want to remind you that I do have another YouTube channel called Stan the Annuity Man, where I've done pushing 400 videos on products and questions people ask, and just, they're 5 to 8 minutes. You'll love it. It's me, man. It's me. But getting back to the living the contractual, living the reality, not the dream. Today's guest is important because he's all about that. I mean, his company is one that we use here at theannuityman.com. His name is Gary Baker. He works with a company called Cannex, C-A-N-N-E-X. I've known him for a long time. I consider him a friend, and we're both kind of music junkies. We like music. So most of the time when we talk, we're not talking annuities. We're talking about music. But today's podcast is going to be a good one. So hang in there, because we're going to kind of get in the weeds and talk to you about how the sausage is made. So when you go to theannuityman.com, and we have the best calculators on the planet. You can go there and run quotes for SPIAs, single premium immediate annuities, DIAs, deferred income annuities, and qualified longevity annuity contracts, QLACs. The company behind that, the machine behind that, is Cannex. So with that, I want to welcome Gary Baker from Cannex. Welcome, Gary.
Hey, Stan, how you doing?
Doing great. So let's just jump in. Tell everyone a little bit about you and your background without getting too sappy about your alma mater, Penn State.
Okay. Well, the tear comes to my eyes a little bit sometimes.
Yeah, we are Penn State, right? So tell us about you and just kind of your background, and then we'll just dive in from there.
Yeah, sure. Well, I'll work backwards. I've been with Cannex now for about 10 years, and and roughly speaking, and we'll get into what we do a little bit further down the road here, but we operate a pricing and data and illustration business with some research involved in supporting the annuity market. So, but before that, I was with MassMutual for about 5 years and ran their product and marketing for their retirement income business. And then before that, with GE Capital for about 20 years. Doing a variety of positions and business units there, but about halfway through that stint with GE, kind of declared my major into the retirement market, if you will, with the bits and pieces that were purchased over time, which eventually became Genworth. But before it was Genworth, it was GE Financial, and
I remember the whole Genworth thing. Yeah, exactly.
Yeah. So that's a story unto itself. So maybe that's a different podcast.
That's a different podcast.
Yeah. So, but again, getting back to Cannex, really pricing and research around annuities. What we do is support service providers as well as distributors and carriers too, and bringing them all together where we can actually normalize and standardize, if you will, the product offerings to demystify them for both consumers and advisors out in the market. But at the same time, insurance carriers need to provide value. And they work actually very hard on providing value to the policyholder or the client. And in doing that, they also have to differentiate amongst themselves and they have to maintain at least some form of profitability to maintain a business. And anybody out there who runs a business, you need to have more revenue than costs. So, I mean, they're not any different than any other business out there. But when they do that differentiation and when they try to create more value and be unique, unfortunately, that creates some complexity.
Right.
And some and really depends upon what you really want to get out of that annuity. So what we try to do is really bridge the gap between the complexity that's actually somewhat required from the insurance carriers when they try to create that value, and then the simplicity that you and your clients need, as well as other financial professionals out in the market. So we try to bridge that gap.
Yeah, and it's what my listeners need to understand is the work that they do is the heavy lift. I mean, you go to my site and run the quotes, and the quotes pop up. The heavy lifting is on Gary's side with Cannex, because they have to have relationships with all of the carriers. They have to update the current numbers. They've done all of the hard infrastructure work. Now, I pay Gary a large fee for that information. No, it's very fair. But what we like about it at theannuityman.com is, I always say annuities are commodity products. You shop for them like you shop for a plane ticket, and they, these quotes expire, like a gallon of milk every 7 to 10 days. What Gary provides to us, which is fantastic, is that all carriers, all with quotation marks around it for the podcast listeners, pretty much every carrier on the planet uses Gary because they want their product or their SPIA or a D or QLAC in front of, and other products too, index annuities, whatever, but we primarily use Gary for SPIAs, Ds, and QLACs. They want those products in front of my client's eyes or prospect's eyes. And so that's, his firm, to me, I don't really think they have competitors, in my opinion, because obviously I know the industry, but the work that they do is groundbreaking. And so let's kind of go into, because I want my customers and clients and prospects and people listening to this podcast, because Gary, as they say, everyone hates all annuities, right? Which is crazy, because it's like saying I hate all restaurants. There's many different types of annuities. With SPIAs and DIAs and QLACs, these are transfer of risk lifetime income products. In most cases, people are setting up for lifetime income. Yes, you can do period certains, et cetera, but we're not going to talk about that. We're going to talk about lifetime income, because that's what annuities were put on the planet. Talk about you're a smart guy, kind of bring it down a little bit so people can understand the pricing of lifetime income.
Sure. So, really what you're doing is you're buying insurance, right? And
income insurance. I call it lifetime income insurance, retirement income
absolutely,
insurance.
Right? You buy a life insurance contract in the event that you die too soon. You buy an annuity in the event that you live too long, right? So it's both ends of the spectrum. And so theoretically, you're running off the same risk pool for an insurance company to be able to price for that. In the case of income insurance or an annuity, you're looking at a couple factors. One big factor is the mortality table. So, your
life expectancy for us peons that didn't go to Penn State, life expectancy.
Exactly.
Okay.
So, when you let's bring back when you have to do required minimum distributions and your retirement, and you have to go to the IRS table, and the IRS gives you a uniform lifetime table, of which then you make your calculation of how much money or the minimum amount that you're going to allow Uncle Sam to tax you back, because Uncle Sam wants the money back, right? So it's a similar table that you run at the insurance company, where it's a little bit more complex than the one you're going to pull up on the .gov website to do your required minimum withdrawals. But but in that case, it gets a little bit more fine-tuned, because you can have a different mortality table for men versus women. And then in some cases, certainly on life insurance, they can get it down to zip codes these days, which as far as their demographics, as far as how they're going to predict how long you're going to live. But
hey, Gary, digressing a little bit, do you think there's an evil plot out there for women to live longer than men? Yes or no?
I have no comment on that.
It does seem, though, that when life insurance companies are pricing mortality tables, life expectancy, the females are projected to live longer. I just, me, Gary, I wear a tinfoil hat most of the day. Right. So that's my conspiracy. So get back to the pricing of SPIAs, Ds, and QLACs.
Yeah. So anyway, but in the case of annuities, so I'll make the analogy back back to life insurance, when you go buy a term life insurance or even something more permanent, they're underwriting you based upon your health, right? And whether
Right.
you smoke, and potentially other factors, right? And
Right.
then they're going to quote your rate, and you don't know what rate you're going to get until you get a blood test or spit to a cup, or they kind of assess your general health. In annuities, for the most part, at least in the U.S., insurance company assumes you're healthy, right? So they're going to assume that you're going to live, you lead a healthy lifestyle, nobody smokes, and you're going to live to the absolute fullest to that mortality table or to that life expectancy.
So the life insurance company thinks everyone's living in a perfect world. In essence, all kidding aside, they're taking the 70-year-old or the 75-year-old and they're grouping them with all other 75-year-olds of that gender. Is that correct?
That's correct.
Okay.
Right. And so over, with the history of actuaries and being able to predict these tables, and these mortality tables or life expectancy tables, they do get updated over time. 100 years ago, somebody like you or I, they're saying, well, your life expectancy is probably gonna be around 50 years old.
Right.
So since that time, they have changed dramatically, where then they're putting folks like you and I up into the mid to late 80s now, as far as that type of life expectancy. You could even argue that 20, 30 years from now, those ages will continue to increase to some degree.
So life expectancy drives the pricing train. And in essence, when you buy a lifetime income annuity, you're saying to the carrier, I'll take that bet. I think I'm going to live longer than you predict I'm going to live. And if I do live forever, you, the carrier, are on the hook to pay. That's the reason I always say there's no ROI until you die, because it's a pure transfer of risk. Because people always say, well, what's the return on it? I don't know that. Gary doesn't know that until you die. So life expectancy drives the train. And I think one of the things, Gary, that people, I get these calls all the time. Well, I'd never buy a lifetime income annuity because if I die, the evil annuity company keeps the money. And if you, as people know, if they've listened to my talks and videos, you can structure the lifetime income stream so that the annuity company is on the hook to pay, regardless of how long you live. But if you die in a fiery Learjet crash, if you're on Gary's Learjet and you die with Gary doesn't have Learjet, I don't think. But the point is, then 100% of any unused money would go to your beneficiaries, and the evil annuity company doesn't keep a penny, even though they're on the hook.
Right.
How, as an industry, do you still hear, from people that's a common belief? Because I know with journalists, a lot of financial journalists believe that everything is what's called life only. When you die, the money goes poof. But that's just about 30 to 40 different. There's 30 to 40 different ways to structure it.
Right.
What's your comment about the structuring? And maybe you can talk about life only versus, say, life with cash refund.
Yeah. So with the contract, what you really have available is the option of a death benefit. So what I would say is that the academics, when they look at the pure annuity contract, they're going to look at an annuity contract without a death benefit. And that's the one where, if your Learjet hits the mountain, the insurance company keeps the bet. So again, getting back to that lifetime table, if your life expectancy is 85 years old, half of you are going to live past that. Half of you potentially are going to die before that time. So it's really a bet on that. But, getting back to the death benefit, the insurance company is going to pull that risk and think about, pricing to the fact that you're going to live to 85. But the fact of the matter is, what's available to you as an investor is that you can then place a death benefit or some protection for you, so that if you do pass away before that time, or earlier in your lifetime, your beneficiaries can receive a portion of that, at least getting the rest of your premium back to your estate. There's different variations of that. So if you're going to get that death benefit on top of that income payment, your income payments could be a little bit less than if you didn't have that death benefit. So for example, if you put $100,000 in and you get $500 a month, I'm just throwing that out there as an
Sure,
example.
sure.
For a life only or a no death benefit type of contract, that could be your price. If you decide to get something like a cash refund, which is by far the most common death benefit purchase today, and I would say it's about over 50% of the contracts purchased today have a cash refund option. Your income's going to be about 490, 495. So you're taking a little bit of a haircut off that monthly income payment in return to protecting your estate to make sure at least they get the rest of your money back.
As we say, the annuity companies have the big buildings for a reason and the logos on the plane for a reason. They don't give anything away. So if you want to attach guarantees to that lifetime income guarantee, then they're going to just simply lower the payment. Same thing with cost of living adjustment increases that you can attach to the policy. That, as Gary, kind of explain cost of living increases and what the choices are and how it's priced.
Well, actually, that's a really good question. If anything, those are starting to get phased out today. But a cost of living increases, if you're worried about inflation. So again, it's a feature of annuity that appeals to maybe some consumers who are concerned about inflation.
Sure.
And if that is a concern, and if you're truly concerned about what your dollar is going to buy 10 years from now, you can buy a contract that will increase your monthly payment by a particular percentage, let's say 2% per year, 3% per year, 4, even 5, or higher. If you do that, again, it's a seesaw effect. Your initial monthly, I'll go back to the this example in pricing I gave before. Again, instead of $490 or $500 a month, you may start at $450 or $460.
Right.
But that income payment is going to grow over 5, 10, 20 years, to the point where you're going to get up into the 550s or even 600s, depending upon how long you live. So again, it's a trade-off. It's like a seesaw, if you will, but I would say that only about 2 or 3% of the contracts purchased today have that type of feature added into it, which kind of tells you that people are really buying these contracts for the floor fixed guarantee. They want to cover, they want to cover the mortgage, the utilities, the basics, the essentials, and that's something they can budget to. And then any variable costs or any inflation risk that they may see in the future, they're going to cover maybe with other assets in their portfolio.
And we call that the income floor. The income floor is the guaranteed amount that's coming in. And I always tell people, inflation is always the gorilla in the room when people talk to me. Well, what about inflation, Stan?
Right.
There's not a contract that solves for it. Okay. And I know some agents will tell you they have it. They don't. Annuity companies don't give that increase away. Typically, we tell people it's a 6 to 9 year break-even point, and that's just ballpark of if you compare the same exact annuity with and without a cost of living increase. And one thing also, Gary. What we're seeing is really the carriers have opted out of the CPI, Consumer Price Index increases. I think the last carrier bailed out last year. Are we seeing any CPI increases attached to DIAs and SPIAs right now at the time of this taping?
No, there's none that exist in the market, at least from what we see for the primary carriers out there. I mean, I would say there's about 2 dozen or more carriers that are that really lean into the income annuity market. Especially parties like yourself that market them, and none of them have a CPI today.
Love the contractual guarantees. As you know, that's all we do. You own an annuity for it will do not what it might do. That's that's the saying on my hat, for gosh sake. What side it will do is on that side right there. So I wear it on my sleeve. I wear it on my hat. Gary, where do you think, there's 10,000 baby boomers that hit retirement age every single day. For smart people like me and you, and yes, I'm grouping myself with you at this point. We consider that a demographic tidal wave, right?
Right.
Do you think the annuity industry is doing a good job addressing that? Because I don't personally. I feel sometimes like I'm screaming into a hurricane, talking about contractual guarantees. What's your feeling on how? Because let's stop for a second and just explain that lifetime income, the transfer risk of lifetime income, is a monopoly that only annuities can provide.
Right.
Tell me your opinion, without making anyone mad, about how this message is not being conveyed to people that need these transfer of risk products.
Well, that's a loaded question with lots of
Yes,
different
that's why you're
answers.
here, Gary. This isn't easy, man. Come on.
Well, at a very high level, it has to do with behavioral finance, I would say. So,
Okay,
you
go
have
further.
the
Go
pure.
further. I want to hear it.
Well, there's the technical answer, right? But
Right.
but there's human nature, and when you talk about any type of guarantee or your viewpoint of how you view your own money, um, either today or in the future, or your savings behavior, or whether or not you can even cognitively think about what life is going to be like 10, 20 years from now.
Right.
I think many people just have a difficult time having that view. Most of us live in the moment. Are we going to eat the chocolate cake or do we go to the fruit cup?
Well, in an raging bull market, that's the biggest chocolate cake I've ever seen, Gary. I mean,
Right.
it's hard to take money off the table, fear of missing out, FOMO, whatever you want to call it, and then lock it into a contractually guaranteed product. Because I think one of the things, if I was annuities are annuity god, whatever. Well, I kind of am the annuity god. Well, never mind. If I was in charge of the annuity industry, I would talk about, the guarantees, the transfer of risk, the pensions that no one has
Right.
anymore because we're living a pensionless world. I think less than 10% of private companies even offer a pension. So, and Gary Baker, the annuity data maker is what I'm going to call him. He provides the contractual guarantees and that those numbers so that people can make those decisions. So, what else about kind of the future of the industry? Like where do you think it's headed? I know right now annuities are a niche industry, which is
Right.
fine. But if you look at the demographics, it really shouldn't be a niche industry.
Right.
Where do you think the future is headed, especially with an aging population?
Yeah. I mean, look, at the end of the day, people have to rely on an advisor or a financial professional or somebody like yourself to kind of guide them through that conversation. Look, an annuity is a complex instrument, or it can be, and it needs to be configured to the need of a particular situation or for the individual.
Correct.
I think in the past, in some cases, it got sold as a Swiss Army knife. It's going to do everything for you. But the reality is, based upon what your value is and the fact that you configure these contracts specific to the guarantees is one thing.
Right.
But the annuity contract has been built to either provide insurance, basically 4 basic types of insurance. There's a tax deferral, if you want to call that protecting from Uncle Sam insurance, right? There's the death benefit that we talked about. There's a income benefit, which, it's a little bit different than income annuity, because an income annuity, which is the pure essence of annuitizing your contract, but if you want your cake and eat it too, having access to your liquidity to your account while also having a guaranteed income, then you have these income benefits. That's another form of insurance.
And those are called income riders. I've written a book on that. If you want to get the book, go to my site and get it. But that's what Gary's talking about. Income benefits are income riders attached to policies that offer a lifetime income stream starting at a future date of your choice.
Right. Yep. And then finally, some contracts have what I'll call growth insurance. So if you actually want to invest money into the shell of the insurance contract, there's some floor protections that make sure, if the market goes south, your exposure is limited, to those losses. So,
and what he's talking about there is indexed annuities and what I call buffer annuities, or I've named them copay annuities, but those are a little bit, those are products that allow some upside lock-ins with some limitations on that upside. But yeah, there's a lot of new products that are coming out. A lot of them are complex. I always tell people, if you can't explain it to a 9-year-old, don't buy it. No offense to 9-year-olds.
Right.
But Do you, Gary, do you,
Oh, well, I guess what I want to do is I set the stage for that
oh my
because
gosh, I don't want to get in front of the stage. Go.
that's okay. But the reason I mentioned those four types of insurance and about where the annuities are going in the future, I think in the past, you could argue that some people bought all four of those combined in one particular contract, and you could say, well, that's not necessary. And I think where the future of it's going is that the need to really figure out what you want. What do you want to protect? This is insurance, so what is it that you're looking specifically to protect, and then frame the purchase of that annuity or the components that you want to fit your overall plan and what your overall objective is, if you will. And when you talk about contractual guarantees as a basis for that, that's a very simple proposition. It's easier for you to get your head around. But if you have more complex estate issues or
Sure.
or income plan that may be a little bit more involved, then you may want to take some of these other elements and plug it in. And I think it really it's not only the education to the consumer, but it's education to advisors and financial professionals. So, I think
that's a good statement. That's a really good statement, because there's a lot of advisors out there that they don't even know what a QLAC is.
No, exactly. And I think if you really look at, even for certified financial planners, if you look at their accreditation and all the studying they have to do, hours and hours, weeks, months, years, and volumes of pages that they have to review, hundreds of thousands of text, and as far as and even the books and the tests they have to take, annuities are on page 327, and that's it.
And it's written poorly. They didn't have me write it, so I totally get it. From Cannex's standpoint, on your day to day, and you're overseeing, obviously you're the grand poobah, and you're kind of overseeing all of the people that work for you and going in different directions. What's the biggest challenge for Cannex at this point, working with carriers, in your opinion?
Well, I think carriers, again, getting back to the fact that they want to deliver value. It's interesting. There's a lot of development, a lot of investment going into the industry right now to simplify the sale of an annuity, so it's as easy to get a hold of one like a mutual fund. In order to simplify that, you need a process by which people can, break these things down and really understand what is inside each contract in a concise manner, basically an apples to apples view, so that you can make an informed decision. I think some carriers see the challenge that, well, you're commoditizing my product, and that's not the case at all. If anything, by simplifying and breaking it down, you're actually exposing what the unique value that they're trying to bring to the table. Some carriers are going to go for 72-year-old women. Some are going to go for 45-year-old males. Or, depending upon their profitability model, or not, maybe I wouldn't, that's a wrong term to use, but basically what their target or their business plan is relative to how they want to serve the market, if you will. And so they have their own unique mission and what they want to deliver. And by simplifying that, you're able to highlight that. But I think some carriers still wrestle with the fact that you're peeling away the marketing layer, showing exactly what's available, and allowing people to make an informed decision. So I think that's going to continue to be a kind of a catch-22 out there.
And I would probably bet that when, the Orbitz Priceline type model came out, that was a consolidation of all the plane tickets and all that. They probably had similar blowback at that point in time because they didn't want to reveal everything. But pro-consumer, it has to be pro-consumer. I mean, one of the things I've trademarked is annuities made simple. We're trying to simplify it as well. And I think it's important for the carriers, to simplify it going forward. The direct-to-consumer model, Gary, is something that I and a handful of others are trying to pioneer out here. I think we're very early in the game. I think it's it's something that with the simple products, even the very simple products like SPIAs and DIAs and MIGAs, which are the CD alternative, the annuity industry version of a CD. Even to this point, those need explanation and guidance.
Mhm.
Do you ever see a time in the annuity industry where it's maybe not a pure direct to consumer, but as close as you can get?
I think technology will have to be involved in that. Again, I'll make another analogy. I mean, can you fix your own car, or do you have to go to a mechanic? Or
Listen,
or do you have to go to a doctor, or are you going to perform surgery on yourself? So
yeah,
again, so there's simple uses of annuities, and there's more complex uses of annuities.
right.
And I think for the simple application of an annuity, whether or not I want an alternative to a bank CD, yeah, I mean, I think that's definitely a direct proposition, and that
Yeah.
happens today, right?
Right.
If you're looking to take advantage of some of these other unique features, again, for maybe more complex planning needs,
Right.
you have to go to the specialist that's going to kind of configure the product for you at the end of the day. Now, the question is, with artificial intelligence, could technology get to the point by, through software that could help you guide yourself, through that? Well, I don't know. I mean, you got WebMD, right? We're all doctors now, but we still misdiagnose each other, right?
I get it.
I think you still need some human the eyeball contact also with these products. That's just the nature, and that gets back to the behavioral finance element of this, and
Right.
and if there's a trust me factor around annuity too. Let's face it, because it's insurance, and you have limited liquidity, regardless of the type of contract that you hold, and regardless of what somebody may tell you that you can get your money out anytime.
Well said. Well said.
Right? So people want to know, they need that trust, that, okay, I'm giving you some of my money, I'm just going to be there for a while.
Yeah.
They want the trust me factor on that. And so it's tough to get that through a robot.
Well,
or through a
and the
website.
annuity industry has earned its bad reputation from a sales standpoint. And it's not the carrier's fault. I say that all the time.
No.
The carriers put out the products, they put the disclaimers on the products, they put the sales stuff out, material, but they cannot regulate or oversee what every agent says.
Right.
And, we run across it every day when people call up and give me the sales pitch. I'm like, either that guy's a sociopath or they just really haven't done the research on the product. So,
yeah.
In closing, Gary, first of all, thanks for being here, and I want you ongoing. What would you tell people from the standpoint of, and this is a big one that I get all the time, and maybe we can close with this answer.
Right.
Timing the purchase with these type of products, especially when people see the interest rates at perceived lows, when me and you both know the 10-year treasury, when looked upon with competing 10-year treasury equivalents across the globe, it's still pretty high. What do you tell people about, what would you say to a person listening to this podcast that they're trying to time their SPIA, DIA, or QLAC purchase? Do you say, that's a tough one, you're a fool, or maybe that works?
Right. Well, if that's a concern, right, for some people that's not a concern, right? There's other overriding factors that's a little bit lower on the list. But if that's a concern, there's two things that I will tee up to counter that. One is, if it's an income annuity, if you're buying income, guaranteed income, you're actually getting three forms of return. You're getting your principal back, you're getting interest on top of that, and then you're getting the mortality credit, right? Which you can't, or the last person standing credit, right? Which is part of that whole lifetime income that you're making and the insurance company is pricing to. So any other, like if you buy a bond, you only get the interest and principal. You get an income annuity, you're getting interest principal plus that mortality credit. So, so you can never time that, and that's always going to counter that. Now, certainly with
great answer.
Well, thank you. But the other element of that is, and maybe sticking with the income annuity need with guaranteed income, if that in fact is a concern with you, you don't have to buy it all in one shot. right? So you can
Right.
ladder into these things,
Ladder into it.
right? Or dollar cost averaging. I'll put some in this year. I'll put some in next year. I'll put some in the year after that. And
Right.
over those purchases, then you diminish that risk, that perceived interest rate risk. On the investment side, as far as what you saw on MYGAs, right? The fact of the matter is the fixed rate annuity is still, at least in the United States, because of the rules that you have around insurance contracts, the insurance company is able to provide you a better return than if you were to walk into the bank and purchase a bank CD. And by the way, the price, these are spread products, right?
Right.
So, it's, when people say, well, annuities are so expensive. Well, well, it depends on which one you're talking about. But
what are you talking about? Yeah.
The MYGA, that's priced the same way, essentially, as a bank CD, which is, are you getting 3.2%? Well, it's actually, they're pricing it so it's returning 3.5, and they're taking 0.3 off the top to cover their administrative expenses and distribution expenses. And then you get your net 3.2. I don't know where you're going to find 3.2, but
exactly.
Well,
at the time of this taping,
maybe they'll find it through you.
Well, and I always tell people when life insurance companies price MYGAs, because people say, well, why can't CDs have this? Well, it's a dynamic pricing model. I mean, life insurance companies sell life insurance, and life insurance companies sell lifetime income products, and then life insurance companies sell these MYGAs. And then in addition to their Barack Obama, Donald Trump, Bill Clinton, and Bush bonds in the portfolio, then they can price things a little bit more dynamically than a static bank looking at a 10-year treasury note. And so, I mean, I think that's the big thing. Hey, by the way, for all the listeners that just heard that jet go by, that's not a jet. I think that's the lawn service around my office. So good timing, Stan the annuity man. But hey, Gary, this is raw. This is real. This is down and dirty truth about annuities, which is the reason I'm glad that you came on the program. And once again, Gary is the Grand Poobah. He oversees. Gary, what is your title? You president? Or they call you Grand Poobah? What are you?
I don't know. It changes every day, honestly.
But he runs Cannex, okay? And Cannex is the data system that when you go to the annuity man and you get those quotes and you can run them 24/7, 365, and you say to yourself as you're running them, man, I love Stan the annuity man for providing this service to me so I don't have to talk to him because he's a little intense. When you say that, you're really saying, thank you, Gary. That's really what you're saying. The translation is, Gary, thank you so much that I don't have to speak to Stan when I run these quotes.
It's way too much.
So with that being said, Gary Baker, I really appreciate you being on the #1 annuity podcast on the planet. And it just happens to be called Fun with Annuities. And I'll see you next week. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MYGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 annuity owner's manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.